Hi, I'm Tom. Today we're going to be talking to you about sustainability and how it affects financial reporting. Berta will be talking about sustainability reporting and where we are now. I'll then talk about sustainability standards and where we can go. Tim will be talking about who the stakeholders are, and Michael will finish by talking about who it will all affect. He's then going to answer some questions given to us by the class.
Hello, my name is Berta and I'm going to be talking about sustainability reporting. Ask yourself, what does sustainability mean to you? The most often quoted definition of sustainable development came from the document Our Common Future Report in 1987, which states that the sustainable development that meets the needs of the present without compensating the ability of the future generations to meet their own needs. Sustainability accounting is not only environmental issue, it also takes into account social and economical issues, like we have water, energy, human rights, fair trade, economical and non-financial performance. Ultimately, sustainability accounting requires considering of all these overlapping factors. Without the sustainability business model, organizations will not have a sustainable long-term strategy for global economy. The Global Reporting Initiative is a multi-stakeholder organization that is committed to supporting and developing sustainable reporting guidelines. They put out a sustainable reporting framework that is now widely used around the world. The GRI guidelines establish the framework, providing a principle to establish how to report and the standard disclosure to establish what to report on. The benefits of these standards is to be able to have a consistency and comparability. GRI recommends 5-step process on how to incorporate sustainability reporting in the organization. Number 1, prepare. What does your sustainability report might want to have contained, and what is the major topics do you want to include? Number 2, connect. Identify the key stakeholders and ask them what would they consider is the most important sustainability topic they would like to report on. Number 3, define. Analyze information get from those stakeholders and discuss in your organization the topics you actually want to report on. Number 4, monitor. Is to achieve progress recording data and ensure that the quality of the information gathered is what will influence on the performance goals. Number 5, report. Write and communicate the results in the report. Sustainability reporting is a key tool to set up goals, to measure progress and manage sustainability within an organization. Reporting on the organization's sustainability performance will give the internal and external stakeholders a clear idea of the impact the company is doing. This will improve the organization's efficiency and move forward to a sustainable future. Financial accountants will need to develop a set of customized tools to allow their clients to ensure opportunities and deliver results for sustainable reporting. This will make the organization more sustainable across their environmental, economical, and social systems. Thank you, and I'll pass this on to Tom.
Hi, I'm Tom, and I'm going to be talking about introducing sustainability standards. Reporting on environmental and social performance is now standard practice in business wherever in the world you may operate. The KPMG survey of corporate responsibility reporting found that almost 3/4 of the top companies across 41 countries now issue corporate responsibility reports. That figure rises to 93% among the world's largest 250 companies. This is a quote taken directly from KPMG's website. 93% of the 250 largest companies in the world are issuing sustainability reports. So then, why is it not mandatory for all Tier 1 companies who are required to report under International Financial Reporting Standards to report on sustainability? A benefit of introducing IFRS standards for sustainability is that there is a potential for further education opportunities for accounting students. This could be in the form of additional university papers specifically addressing the issue of sustainability. As we move forward in this direction, there is potential for a new major with the title Sustainability Accounting. Most definitely a growing, in-demand career as the world moves away from myopic behaviours in favour of a focus on the future. These standards would be based around reporting three key elements. Firstly, companies would be required to record quantities of certain inputs used in their production and distribution networks. Such inputs could consist of predetermined consumables which are considered to not be a sustainable alternative. Examples include such consumables as coal, which is commonly used in electricity generation, or diesel for transportation. All consumables are easily quantifiable as to show the specific amounts used and where there would be no need for companies to report on how much has actually been spent. Now that we've spoken about the inputs, we can move on to the outputs created in production. Again, this would consist of a predetermined list of outputs and pollutants. Examples could consist of output of non-recyclable plastic in tonnage and CO2 output per unit of production. Now that I've spoken about the inputs and the outputs, I'm going to talk about the third key factor, and this comes in the form of investment of rectification. The third key element is for companies to report the specific amount of money invested and expensed in rectifying and improving their impact on the environment and projects for sustainability. There would be no penalties for a company who records this as a zero. It is simply an exercise in public opinion. Companies who are socially aware and are trying to maintain a green image will benefit from factual, standardised reporting standards, and those who are not concerned with such matters will be cast aside. The idea is that by introducing three key elements to report on, there will be a shift away from lengthy sustainability reports which are more self-indulgent than beneficial to sustainability. I will now pass you on to Tim.
G'day, I'm Tim. As we've decided, sustainability accounting is a growing phenomenon and we think it should be made mandatory through IFRS standards. If it is enforced, entities will be required to showcase the impact on sustainability. They'll be able to combine their long-term profitability with good ethical behaviour and environmental care. I believe this will improve stakeholder value. Stakeholders are interested parties in the way an organisation is run and the results it achieves. It is a given then that some would be interested in information regarding how an organisation's day-to-day activities impact on sustainability. Some of these interested parties include, so firstly, primary stakeholders that will be affected from these mandatory statements. Firstly, we've got the customer here. I believe that some will be more inclined to the more green organisations. They may feel against supporting companies with no concern for the environment. They'll be more attracted to the organisation with a more positive brand and image. Then we've got the employees. I believe these will be interested stakeholders and enforce sustainability reporting. This may pressure firms to focus more on this area. There may be peace of mind or comfort for certain employees working in the organisation that supports the future and welfare of the planet. They may feel through their employment that they're helping achieve the entity's objectives, one of which being sustainability, which will be made transparent through these statements or reports. Right, thirdly, down the bottom here we've got current and prospective shareholders. I believe these will also be interested stakeholders. By tracking energy consumption and wastage of stock and inputs, the organisation could potentially find ways to save costs and be more environmentally friendly. Broadcasting this to current and prospective shareholders indicates the firm is finding ways to save costs, resources, and also improving sustainability. So we'll also benefit from increased stakeholder value, such as customers being attracted to the firm with a more positive image and reputation, and intangible qualities such as satisfied and motivated employees, which we all know how important to a business this is. One slight drawback, however, would be the extra training that managers would have to spend company resources on in teaching certain employees in a specific area. This would also mean extra base knowledge taught to accounting students in their studies. Overall, though, I would say shareholders, both current and prospective, would still be interested in enforced sustainability standards. Okay, next we've got the secondary stakeholders to the organisations, the ones with more indirect sort of impact from the business's activities. We've got local communities. I believe the ones anyway that are geographically situated near certain entities, they'd also be interested in enforced reporting. Noise and air pollution are a major concern for those in the area. I believe sustainability accounting would pressure firms into improving their impact on the environments to avoid this bad reputation that comes with it. And lastly, we've got the government. I believe that from enforced sustainability standards, they will collect a lot of homogeneous comparable information between organisations, and from this they could find problem areas hampering sustainability. They could perhaps impose a tax to discourage this activity, and then there's potential to redistribute these proceeds to new initiatives improving sustainability. So overall I believe that sustainability should be one of the key objectives among entities to try and pursue. It not only benefits the planet and our future generations, but also it positively impacts presently on many interested parties, the stakeholders. Now I will pass you on to Michael.
The sustainability challenges for financial accountants today are unprecedented. However, step-by-step financial accountants can head in the right direction. The need for sustainability standards has been clearly outlined by Berta, Tom and Tim. The question now is, what will these standards achieve in sustaining the planet? I'm now going to talk about the challenges and opportunities for financial accountants and students in relation to sustainability. There is a clear role for the financial accountant in sustainability reporting. Financial accountants have much to offer in terms of core skills which are essential to developing more robust, consistent, effective and useful sustainability reports. Sustainability reporting provides a number of challenges and opportunities to financial accountants. In particular, professional development, including establishing a deeper understanding of the interdependence of social, environmental and economic issues, as well as long-term and future-focused accounting practices. For accounting students, this means not only learning private accounting practices, but having to study and understand social, environmental and sustainable development issues. The ability to have to link both financial and non-financial indicators and outcomes together means student accountants will require a deeper knowledge of these non-financial elements. Overall, sustainability standards will mean that financial accountants will develop a much deeper knowledge of the environment, and they will learn about ways in which we can sustain the planet to a greater extent for the future. I'm now going to move on to the topic of greenwashing. Greenwashing is the glossing of a company by providing only positive environmental information that the company has done, and in some cases hasn't done. In doing so, the company leaves out the negative ways that their particular company is damaging the planet, and thus painting a beautiful picture that their company is only affecting the planet in positive ways. The implementation of sustainability standards would mean that greenwashing would be strongly removed from financial reporting. Companies would have to follow set standards, which would mean that the truth of their impact on the environment would be recorded accurately. Companies will now become more accountable for their words and actions, and if caught out in greenwashing, there would be negative impacts that would flow. For financial accountants, this would mean much more correct and regulated reports, and would also see environmental prosperity through company implementation of their environmental sustaining ideas, thus assisting in a positive way on the planet. Future generations, our kids, their kids. This leads me to my final point of future sustainability of our planet. By implementing sustainability standards, we will be able to ensure that we take enough of what we need now and leave enough of those to follow. This statement shows by sustaining through regulated standards, we would create better use of resources and therefore cause less pollution, emission and negative impacts on the planet as a whole. As people move more towards more environmental friendly ideas and morals, it requires companies to follow. As financial accountants, we want them to follow in a professional manner, and the implementation of sustainability standards in financial reporting will mean that companies can follow these demands, but in doing so respecting the environment and ensuring its prosperity for the future generations. Sustainability standards will leave a good platform for the future generations to continue the obtainment of sustaining the planet. In conclusion, our group has discussed the relationship between being a financial accountant and assisting in sustaining the planet. As financial accountant students, we felt that the need for sustainability standards was paramount in order to assist in sustaining the planet. Berta touched on the topic of where we are and where we have been in regards to sustainability reports. Tom looked at sustainability standards based on 3 key elements of inputs, outputs and expenditure. Tim discussed the significance and interaction of stakeholders in sustainability standards, and I discussed what standards would achieve in sustaining the planet. We believe implementing sustainability standards would have to begin from the top and work its way to the bottom. This means the major firms and corporations of the world need to be the ones leading this charge to a more sustainable future through complying with sustainability standards. We recommend that financial accountants should not shy away from the challenges presented by sustainability reporting, but instead embrace it as it provides opportunities to develop the strengths of the profession in an ever-changing manner. The final part of our presentation is to answer 2 questions from the class. The first question that we're going to have to answer is, how will sustainability reporting requirements impact firms in New Zealand? Currently, New Zealand is required to report under IFRS. If there were to be a shift from sustainability reporting to sustainability standards under IFRS, New Zealand would be required to follow. As this is currently not the case, New Zealand companies are able to follow the OECD framework, which is very similar to the GRI. This now leads me to the next question. The second question is, what is sustainability reporting? We believe sustainability reporting is the reporting of environmental factors by organisations who are concerned about their impact on the planet. The Global Reporting Initiative created a framework for sustainability standards. After completing these 5 steps, the GRI Sustainability Report can help organisations understand, for example, risk and create value, help reduce waste, carbon emissions and water use, help improve efficiency and reduce costs, help enhance quality and diversity within companies. Overall, the GRI Sustainability Framework will help organisations to determine strategy for the future and use this way of reporting to compare and address the need of all stakeholders. That concludes our presentation. Thank you.